Another point is you don't need to agree with everything with whatever I say. You can take some lessons which are useful for you, which you think are useful. If you think I'm talking some nonsense and all this stuff, ignore that part. Or go and read, develop a better understanding, and then correct me as well, right? Right, so we're moving on to the second part. I actually don't know how to come to this particular link, so that's why I cut and pasted. I kept that in the slide deck as well. So the thing here is you get a report called market capitalization weightage beta for all the Nifty 50 stocks. The thing about this report is it will only come once in a month, not the month end. So today is what? 21st. You won't get it. Let's say December. I want December 14th. You won't. You got it, but it would be end of December, I think. Right? So end of December is 31st December. This is a monthly report. What you have here is for all the Nifty 50 stocks and junior 50 or next 50. That's what the index is called. You have what are the components of Nifty as on December 1st. These are all the Nifty 50 stocks. And similarly, you will get for junior Nifty in that other five. And you also get market cap. And what is the weightage that particular stock has in the benchmark, which is Nifty 50? What is the beta of that stock? What is R2 of that stock? I think they calculate this for yearly. 1 year look back on a daily data. That's how they report. Your volatility is nothing but standard deviation. And monthly returns. I'm not interested in this. Or average impact cost. Average impact cost is what? What is average impact cost?
Slippage.
Slippage on what?
Market orders.
So it is like that, but this particular figure is even little sophisticated, right? So what I mean by sophisticated is if I were to construct a 50 lakhs portfolio of 50, how many Adani ports I have to buy? .7%, because that's what the Adani ports weightage in Nifty. So 50 lakhs, 500, 5,000, 50,000, 5 lakhs, 50 lakhs into this divided by 100. So I have to buy 35,500 rupees worth of Adani port. I can buy either with limit order or market order, whatever. But by doing 35,500 rupees worth of Adani ports, I am incurring a slippage of 0.03%. Right, so that's what your impact cost is. Yeah, so So how much is 50 lakhs?
$1,000.
50 lakhs. How much is 50 lakhs? It's a fairly big amount, right? You almost, except in Bombay, you might get a single bedroom in any part of India. Yes or no? And you can buy any fancy car as you want with 50 lakhs. So it's a very big amount. And 0.02% of 50 lakhs is how much?
1,000 it comes. No.
This one, right? 0.03%. Just 1,500 rupees. 1,500 is pretty small amount. Less than half the cost what you paid for this seminar. So the point is, don't worry too much about slippage and all this stuff. So it is just a 1,500 rupees factor in a base of 50,000, 50 lakhs. At the same time, pay attention to it. This is very small in Nifty 50 basket. But this number might be a little bigger in outside the Nifty. What is the maximum in this? 0.03, I think, everywhere. That is the maximum. Lowest is 0.02. So it is not a big deal on a base of 50 lakhs. Right. So, all right. So we have this data every month. So this particular data goes all the way back to 2007 end or 2008 January. Before that, you don't have it. So the last date is this one. Right? Before this, you don't have this file. So the data goes back only that far. Now what I've done is I've taken that file every December and collated those values here. What I've done is the same like concatenation technique is what I've which I've shown you at the start. So I've taken all the price data each year end. January 2008 means December 2007, right? Why? Because I don't have this file for December 2007. I have considered the same data as January data as December data. The reason is I want to see how any of my stocks or models behaved in January 2008. In January 2008, the stock market went down by 20%. So I want to feel that. That's one point you need to remember. And I'm 99% sure I have done all the corporate actions in terms of split and bonus. As I said, I'm not interested in dividends. If I get any dividend, it's good, well and good. If I don't get any dividend also, it's well and good, because I'm calculating on no dividends model. All right. The few other corporate actions that I remember are mergers and acquisition. What is the recent merger that you are aware of? The big merger in Indian corporate history.
I think ACC and Ambuja got and Satyam and Tech.
Satyam and Tekken.
Tech Mahindra.
Yeah, Satyam and Tekken. That's what I said. I don't know about other mergers, value creation or whatever. The very good merger which created value for everybody is ING Vaishya and Kotak Bank.
Kotak Bank, yes.
Right. So what I've done when a merger happens is I've taken the last traded price. Suppose if ING Vaishya was there in my stocks, some model or whatever, instead of December to December, if the merger happened in June, I've taken June as my exit price. Right. That's what I've done. And another thing is there is a demerger that happens sometimes. What is the biggest demerger which created wealth? Yeah, attempt. I mean, if you know. I mean, you don't need to be correct. At least you should participate. That's what my intention. Yeah, what is a successful demerger story? It's right in front of you here, right? This one. Bajaj Auto got
Bajaj Finance from Bajaj Auto, is it?
your entire Bajaj Finance and Bajaj Finserv are from Bajaj Auto.
Okay.
If you that demerger happened in 2008 sometime. For every one share held of Bajaj Auto, you got one share of Bajaj Finance and one share of Bajaj Finserv, and one share of Bajaj Auto, and one share of Bajaj Holdings. 4 companies. I'm not saying 1:1 ratio, but some ratio, but that's what the story is. For that, what I've done is fairly added all the prices and calculated Bajaj Auto prices 783, right? The price could be something else, but because I've added all the stocks, I got this. Similarly, there was one more demerger story in Junior 50. What is that? Adani Enterprises got split into 2 companies. I don't remember what are they in 2011. So if we are seeing this data for Junior Nifty, you will have that corporate adjustment. So that's some knowledge, general knowledge, and actual price adjustments for your information. So with that background, I would say the data is 99% accurate. I might have done mistake. If I have done it, it will be here in this file, so you can dig it and tell me wherever I have done mistake. That's why I say I claim only 99% accuracy, not 100%. right? Now, 2007 means we are investing in 2007 end. So the returns, whatever you see, are for 2008. 2022 returns means we will invest at 2021 end December. So whatever this number will be, that is 2022 returns. Right. So now I have added the price data, right, along with the returns. So NTPC was 250 in December 2007 end, and it has fallen 180 to 180. So it's a 28% negative returns in that year. Like that, we have all the stocks. And you have all the factors here. Whatever is that file gives, right? Everything. And I have done the concatenate and we look up of that particular stuff. Now, what I can do in this file is this particular we look up. This is this year, date, and reliance. We look up of that particular string. Go and look in this and tell me what is that. So 8. 8 is what? Market cap. So this is the starting of the, we look up 1, 2, 3, 4, 5, 6, 8. I didn't count properly, but yeah, that number is, sorry, 7 and 8. 8 is the weightage. So if I put VLOOKUP of 8, it will give me market cap. So market cap is 12.15% weightage for Reliance in 2007 year. If you put 9, you will get ninth number. What is that ninth number here? Beta, right? So 9 is beta. So Reliance beta in 2007 is 1.09. Where you can check. This one, right? 1.09. If I put 10, I will get R2, R square. If I put 11, I'll get volatility figure. Pretty simple, right? Is it simple or complex?
Straightforward, Kora.
Yeah, straightforward. We look up straightforward. Yeah.
Right. So get me the market cap weightage for each stock at each year end. So I got that. So this year IOC has 37% weightage. Coal India is 40% weightage or 0.4%. Right? The highest weightage is Reliance at 10.77%. Infi is at 9.2%. Then HDFC Bank, like this, right? And I am sorting them by in a particular order. So if it is highest, one becomes the top market cap or whatever the factor I put there, because I put market cap now. So 1 is the top market cap company. I just done if else condition. If each year changes, change it. Otherwise, keep adding till 50. Then again, new year came. So again, Reliance, like this. I also can do in reverse order. The same thing I wrote like this. Go to the bottom and mark this as a least market cap company in the Nifty 50. That is one. Second least, 50th least, or top company or bottom company. Now what I've done is if it is less than 10, that means what does it mean? What does less than or equal to 10 mean?
10 companies.
Top 10 companies.
10 companies.
Calculate the average of
from that
top 10
top
companies and tell me what is that average. So this is the top 10 average companies. I put 10, right? So you can see here the right corner. I can't see because one ribbon will come. That's what you will see. 52% for the top 10 companies. Same for the bottom 10 companies. Average of bottom 10 companies. So for 2007, the top 10 market cap companies gave an average of how much returns?
minus 52.
Minus 52%. Right. So that's a story for each year. And the bottom 10 companies, again, less than or equal to 50, sorry, less than or equal to 10 in bottom 10. So we will get some returns. Now, this is your Nifty return. So you have to do it manually, right? So download all the Nifty data and calculate how much Nifty has given in each of those years. What does year means for us? December to December. Now I start with 100 rupees. Because I lost 52 rupees, my 100 has become 48. Now I'm not putting any additional money, I'm reinvesting that 48 rupees. So next year I made 60%. So 48 has become 48 into 60%. Next year I invest that 77. So this 100 has become 343 rupees as of today. By investing in? By investing in where?
Top 10.
Top 10 market cap companies. If I invested that 100 rupees in bottom 10 market cap companies, it has become how much?
268.
268. Don't do this mix. If I invest it in only in Nifty, this is what my returns. Right? 286. Yeah. Ignore this. I was trying to calculate that high minus low factor. But ignore for the time being. If you want, you can calculate. If you want to venture into that 3-factor model. But as I said, like that is too much for you. Right? In the sense, yeah, I don't care all these numbers, even at a 1 crore or 2 crore portfolio level. Right? So I would care all these numbers if I am managing a 1,000 crore portfolio or whatever it is. Now, the average of this is how much?
12.04.
Okay, that is the year is not completed. So this is the average.
12.73.
Right? That is what the 12.73 number average of 10 years or 14 years. Now, if you take compounded CAGR, this is this one. Power of 343 divided by 100, because 100 is what you started and it's a 14 years investment. So you make 9.05% if you invest only in top 10 market cap companies. Your average says 12.7 and your actual returns are 9.05%. So where did the difference go? So where is the difference of 12.7 minus 9% gone?
Is the average.
Hmm? Where is it? I'm not doing any gimmicks, right? I've calculated in front of you.
One is the mathematical average, the other one is CAGR, so different numbers.
Yeah, it's a different number, so they don't match. That's understandable. The technical term for this is, it's called volatility drag or volatility tax. These are the various technical terms that people use in sophisticated academic world. How did I come here? Right, so a term called volatility drag as well. So read if you want to understand it better. Right, so then I've calculated my average standard deviation, then my beta of O is top market cap, right? And my alpha in investing only in top 10 market cap companies. And it's pretty straightforward. You are basically investing in top 10 companies, so your R2 is 98%. There's nothing special you want to do. Your Sharpe ratio is 0.5. I don't know what this 0.5 means. So compare this with Nifty, right? Make sense?
Yes, yes.
Right, so actually this is not a full screen and I can't help it. So you have to go down and remember all these numbers, right? So, and put a CAGR also. If CAGR is confusing, you just put what 100 becomes. This one, right? Because that's pretty easy to understand. If I say 9%, you don't understand what 9% is, right? If I say 343 rupees, yeah, it's a big number. 100 has become 343. Or there is a rule of 72. You can use that rule of 72 to calculate in your mind. But why do you want to torture your mind, right? So we'll use this one. So what is this number? If somebody can read it in 2 sentences. This whole table. Yeah, read it for me.
Average return is around 12.73%. Standard deviation is around 25.62. Basically, that's the volatility which is taken to generate that 12.73. Beta vis-a-vis the market Nifty is around 0.83. Alpha, which is which we have taken in terms of the risk-free return and standard deviation post that, we're getting around 2.98 and
So we are generating 3% excess returns per annum.
per annum. And R square is
This
basically
is a risk, considering the risk that we have taken, right? The alpha figure.
and R square is around 0.98%. That is in terms of Kora, how do you explain R square?
So I can explain and my entire investment philosophy, which is investing in top 10 companies here, is 98% similar to what Nifty is doing at an annual level. That's what it is.
And Sharp is around 0.5% in terms of
Yeah,
the.
so I don't know what it means. So I have to calculate Nifty and compare it with Nifty. Am I doing it better than Nifty or am I doing it worse than Nifty?
And 100 rupees invested has become 343.92 rupees over the 14 years.
That's how. That's a pretty neat snapshot of our investment theory. Our investment theory is we're only investing in top 10 companies, equal weight, 10% each at each December end, and redoing that process every year. All right.
So can we just call it a way that even, I mean, having the correlation of 0.98, so it's like
Yeah.
mimicking the Nifty and getting higher
Correct.
return
It's
than Nifty.
mimicking the Nifty. Yeah. Yeah, I'm not doing anything special. I'm just doing what Nifty does. Right. So if I'm hiding the entire story from you, and I package this as my proprietary model, and if I present those numbers, whether you invest in this model is up to you. I'm not asking you to invest in this model, but if you are investing, how much you are going to pay me? How much will you pay me?
Sorry, can you repeat that?
I'm hiding this entire story, that Excel thing and all this stuff, right? Forget that I'm telling you all the truth. I'm packaging this as my proprietary quantitative algorithmic model or whatever. And I present the sheet which I highlighted, this one. You know, because last 1 hour you spent how to read a returns statement. Now I'm packaging this and I'm selling this as a mutual fund unit or whatever in unit. Obviously, you have to pay me.
Okay.
You have to pay me because I've done some work. Nothing free. So how much you will pay is what my question is.
If you're running an asset management, whatever the maximum fees you can charge, if it's a small,
Tell me that figure. What is that?
so 2.5%, and if it's small case again 100, I mean 1% to 1.5%, and if it is PMS 2 and 20 or up
I'm
to.
very sorry.
The R2 is close to 1.
If you are talking that kind of numbers, like 2% or anything, because I exactly know. I'm actually sorry, but I have to call you an idiot if you're throwing 2.5% numbers, right? So index India ETFs, and this guy maintains a list of it. I don't know how accurate is this and how it is, how timely it is updated, right? So assuming it is error free or whatever. So you have to go and verify. Okay. So, but barring that, I would assume he has done the groundwork or he is reporting the numbers accurately. So this is what it is. Launch date, expense ratio, and a tracking error, right? And AUM. And these are index funds. So probably you have to get the ETFs as well. Collect data. Because you have to do that job. I'm not here to run everything for you. Right? I can tell you how to get the info and make a sheet of your own, right? So now your entire error is your expense ratio, which is, what is expense ratio?
The fee that the fund will charge.
So what is the expense ratio for that Navi fund?
BPS.
0.06%. What does it mean? What does it mean?
So from the
For 1 lakh,
from the
that is
total asset,
1,000, 10,000, 1 lakh into 0.06% divided by 100. So if you give him 1 lakh, he is going to take 60 rupees per year. How does he take this 60 rupees?
on the NAV.
Adjusted in the NAV.
He is going to take this 60 rupees every day on a basis of how many working days? 250 working days. So he is going to deduct, if you give him 1 lakh, he is going to deduct 24 paisa every day. That's what Navi Index Fund does. If you give it to Prudential, he is going to take 17%, whatever is that number, you can calculate. That's a daily. So daily, irrespective of his returns, first thing he will do is he will deduct this 24 paisa and put it in his bank account, and he will report you have 1 lakh minus 0.24. 99,999 rupees 75 paisa is what he will show your account balance, plus or minus that day's returns. Right? Yes or no?
Yeah, that's good.
I'm telling you what happens behind the Navi Index Fund or any of these funds. So this 24 paisa, they use it for their expense or their day-to-day run. Now, how do I evaluate? I evaluate what is best for me out of all these funds. You have about 25 funds, 20 funds. So which one are you going to choose out of these?
The least expense ratio and the least tracking error.
So you add both of them, and whichever is the least, that is the one. So there's no brainer. And just add these two. Right? Of course, this guy doesn't have a tracking error because he launched recently. So he will go out of our comparison list because he doesn't have tracking error. We can't help it, right? Now, what is the least out of these?
Edelweiss.
Sort it. Sort by H. But the problem is these guys doesn't have tracking error, right? So they will go from our list. So this is your best fund. Which one is the best fund? Out of all these three, out of all the ones which we have data, you might have a better fund than this, but that's for your job to find out what is that fund. Right, so IDFC Nifty fund is the best. Second best is SBI, as per our methodology, which is expense ratio plus strike. Right? And how much these guys are charging? How much these guys are charging?
0.08%.
Now you have a good understanding of how much you should pay, right? 0.8 or 0.18 or whatever is that number. Now coming back to my question. This is Kora Reddy's mutual fund or whatever it is, or whoever answered 2.5%, that guy's fund, right? I don't know who is that guy. So he has given you all this data. So how much you are going to pay now?
Compare it with IDFC Nifty fund.
Sorry?
Just compare it with the IDFC Nifty fund, 8.8.
So you will pay 20%, right?
0.08 is what.
So I'm just asking, I mean, answer has to come from you. So will you pay 20% or no? Or how much you are willing to pay?
Because there is not much of beta, and R2 is also on the higher side, you should be ready to pay less than what IDFC fund is asking for.
Less than, that guy also has to make money, right? So I would say somewhere around this. Not 0.8%, little more than that. Because he also needs to make money. But I won't pay 2%. I wouldn't pay this is a ripoff. And your small case are even bigger. They are scam, in fact, not even ripoff. So if I ask you, maybe 0.25%, yeah, okay, you can pay me like 20%, right? And what does 20% means? It is 200 rupees per year. I think this one, right? So about 1 rupee per day on a 1 lakh. Anything above this is little ripoff. 1% is daylight robbery, and 2% if he's charging, he is scamming. It's as simple as that. You may agree, you may not agree with me, but that's how I classify. All right, so I want somebody to step up, tell me the email ID. You have to share and you have to operate the sheet. Yeah, so tell me your email ID, I will send that sheet. Yeah, I will help. There's nothing complex here. Who wants to operate that sheet? Who has a laptop with Microsoft Excel license? I'm going to send that.
I have it, Vinod.
What's your name? Vinod? This one, huh?
Vinod, yeah.
Yeah, anybody else? Sorry? Who else wants to operate? Rajesh or Vaibhav?
I am on an iPad, unfortunately. Otherwise, I
You
would have
can't.
loved it.
Yeah, no. So Ram is there, huh?
Yeah, Kora. Yes, yes.
Ram is there. I'll send
Yeah.
it to you as well. So this is Nifty 50 stocks model. Or attach. Where is today's? This one. Right. So you guys share the screen and I will stop it.
Someone else can share it because.
Yes.
Okay, I got connected.
Recording.
Yeah, download that. So make a new Excel sheet. Just a new Excel sheet. Another blank. Just copy that the highlighted stuff. Not all, the bottom snapshot, which is in bold, all that numbers, and put it there. Not like that. Insert one more column above one, make a heading. That is, forget it. What is B? Top 10 market cap. B, go to B1 and write what is that factor. It is top 10 market cap. Now come back to that sheet. Got on top. So instead of market cap, you change it to the next factor, which is beta, I think. So instead of 8, it will become 9. Yeah, so beta is 9. So put 9. Enter. And copy that. No, copy that J2 across the board till the end. Now what you need to do is select A to L. Select A to L. And go to data, sort. My data has headers. Sort by date. That means each year it sorts. Then instead of market cap, I change it to J. What is that? I've changed it to beta, right? So you should actually change the header. That's fine. Instead of largest to smallest. Again, do that. Sort. Instead of largest to smallest, I will do reverse, smallest to largest. So the lowest beta is now top, right? And highest beta is bottom, like whatever it is. Now come down. You can read, but I'm interested in this particular snapshot. So take that, those numbers. The headings are same, you don't need anymore. So take those numbers and put it there. So what is that heading? Beta low bottom 10. Now do that for other factors as well, like volatility and R2. So R squared is 10. Yeah, okay. And then volatility. You also can get the top, like bottom, right? You also can get the top numbers as well. Yeah, anyway, now you know the method, so you do it. All right. After how to put volatility, which is the last factor. Sort it. Yeah. Yeah, come down. Take that figures. So what is best here? And put Nifty. The Nifty figures you have to calculate, but you know only the CAGR, that's sufficient. It's pretty easy to calculate Nifty. I will tell you a way. Just go on top. Go on top. Just take that entire Nifty column. Copy all those numbers and put it in O. No. Copy them into O. That's Q. Copy them into O. The 2021, forget it because some formula. Anyway, it doesn't matter for you. So, no, the CAGR, right? Put 1.52. In the div by 0, O17. Go to O17. Go to column number O17. Yeah, that you put 1.52. Now you got it. Why it's gone? You didn't put 1.52. So that's your Nifty. Now what you do is go and do Control Z so that you get back the original sheet. Or anyway, you have a copy in the email, so don't bother. So you'll get it. So what is best amongst these 5?
By CAGR, it is beta bottom.
Low beta.
And
Even otherwise,
the second
looks
best.
R2 bottom.
Okay, so the beta bottom, how much it's giving you?
Almost 2 times the Nifty 50.
More than 2 times, right?
Absolutely, yes.
By 622. And it's generating an excess returns of 8.23%. And it has a fairly low R2, 89%. And it has a sharp of 70, which is better than Nifty, which is only 42 sharp. So if I hide the whole story, how I arrived at this stock picking or whatever, you know, you are basically getting a CAGR of 620 rupees. Your 100 has become that much. And you also know it is not highly correlated to Nifty. There is something difference because 89 is the figure. And you are generating pretty much high alpha. If history repeats, you might generate the same in future also. That's a standard disclaimer, right? For past returns are not guaranteed.
This basically means that investing in a low beta stocks over a period of time will outbeat the Nifty.
Pick low 10 beta stocks. That's it. Do it every year, once in a year. So download. He basically delays. That sheet won't come on December 31st. It comes on 3-4 days later. So wait till January 5th. Download that sheet. And pick lowest 10 beta stocks and invest equal weighted. You get 620 rupees after 14 years. If you start with 1 lakh today, after 14 years, that is 2000, when? 2030.
2036.
Yeah, you will have 6 lakhs. Minus tax plus dividends.
Kora, a question here. Are these portfolios equally weighted or
It's equally weighted
equally weighted? Okay.
because we have done average.
And one thing which I find a bit surprising here is that low beta bottom has outperformed low vol by a very significant margin. I thought that these would be closer, but yeah, there's a quite sharp difference between beta bottom and low vol. Isn't that surprising to you?
Yeah, of course. The more data analyzed, the more surprises you will get, right?
Sure. Yeah.
And you will learn something also by analyzing the data.
Right. Yeah, this is a bit of surprise for me. Yeah. Thank you.
Right. So now, given that C, how much will you pay me? Go back to that index ETF comparison site, whatever. So how much will you be paying? No, we don't need this sheet now. So just stay on that other sheet. You guys are willing to pay
Not more than 20%.
see like 2%, right? 0.2%. Now you have to pay for this also something, right? Nothing is free in the world. Right? So how much will you be paying? There's no right or wrong answer. I mean, it has to come from bottom of your heart. You paid 2099 rupees without asking any questions, right? Like that, you have to pay if I construct a small case or if I construct a mutual fund.
This will easily be above.
You guys are paying like 12,000, 15,000, 2% on small cases, right? Without asking questions. Sorry, I mean, nobody is telling me a number.
5%.
0.5% Kora.
0.5%, right? You don't mind paying 0.5%, which is 500 rupees in 1 lakh. And that 500 is basically 2 rupees per day on a 1 lakh investment. All right, so I will take back the screen. What we are doing is we learned the beta is the low beta is the best model, right? Is the conclusion same for everyone? Yes, right? So we'll use the same model, beta. Where is beta? Beta is 9. I have to put small by large. One small problem that you encounter is when doing this blind sort. Look at this chunk. They're all same, right?
I think you need to put the small by large.
Whatever the way you put, still it is 1.11 for those 5 companies which are highlighted.
Okay.
This one, right? This is the same. So the problem here is Bell top 10 or Tata Steel top 10 or PNB or Hindalco. It could be anything. So whenever you have that dilemma, you have to really calculate to the second digit precision or third digit precision. You know how to calculate. So you decide is it Bell or is it Tata Steel or PNB. I don't have a problem here because it's a yes, I can tell it's 3 and 4 or whatever.
So we probably have to increase the decimal places.
Right, so I think I sorted it wrong. Smallest to largest. You still, every year you will get into that problem, right? So you need to be little careful. See, this year, all these 3 are same. So I can't tell whether it's Bajaj Auto is the 10th company or ITC is the 10th company because the question is the same. So that problem is there. I mean, I need to tell you the problems. Also, it's not like blind sort. How do you solve that problem? You go and calculate the beta because I've given you the beta. How does NSE calculate? NSE calculates it by taking the daily values for the last 1 year. So if you are doing on December 31st, 2021, download all the data from December 2022, whatever, and then calculate and then get the exact details. You need to do that only for 1 or 2 companies. It's not a big work as well. Right? You don't need to do up to here. I don't care. But here is where I'm having some problem, right? Yeah, so this is the model which has given us 622 rupees.
Kora, so this is in a sense, this is a monthly rebalance, bottom 10.
No, it's just only once in a year, right?
Okay, once in a year only. Okay. Okay.
Equal weight.
Sure, sure.
Hi, Kora, this is Karthikeyan.
Yeah.
How does it NSE calculate the beta? Is it on a daily close basis of last 1 year or just the last 1 month beta?
Last 1 year daily.
Okay.
Yes,
So if I calculate for this year means I need to get the daily
no,
data.
I mean, we are using just the NS published numbers. We are using last 1 year.
Okay.
I mean, he has given it, right?
Yeah.
Volatility is the standard deviation of daily returns for the period 1st January to 31st December 2021. So he has calculated like that. Beta and R2 are calculated for the period of 1st January to so on. So
Okay.
now what I also can do this stuff is I'm investing in top 10 stocks in equal weighted because I've taken average. Okay? So give me those top 10 stocks for each year. So this is my sheet because there are formulas or anything. I want to come to this sheet. How do I come? So I'll paste the same stuff. So this particular sheet is the same. My returns, the 10 stocks that I selected, and I'm doing a VLOOKUP of again those 4 factors. What are those 4 factors? What are those 4 factors? Weightage, market cap, beta, R2, and volatility. Right?
Volume.
And I have those figures, and those corresponding 4 factors I'm fiddling. What am I fiddling? Suppose there are 3 stocks or 4 stocks, and there is a factor. Your factor is market cap or beta or anything. Let's say this is 1, the weightage of that particular factor, whatever it is. And this is 2, this is 3, this is 4. Just some numbers, and there's no magic involved here. So now, if these are the factors, if I go equal weight, how much my 100 rupees allocation would be in each of those 4 stocks?
25.
It is simple. So 100 divided by total count, which is 4, 25 rupees. Now I don't like equal weighting. I want to go by that particular factor. So how much I'll call this as a straight weight. So my 100 rupees is 100 into this divided by sum of this. So I get 10 rupees. And I get 20 rupees, and I get 30 rupees for C, and I get 40 rupees for D. So my 100 is distributed like that. Right? Is it clear?
Yes, Kora.
Now, what I also can do is, I don't want 1, 2, 3, 4 weighting. I want inverse weighting. That means D will get lowest weightage or lowest allocation. A will get highest allocation. I can call that as an inverse mechanism. Inverse mechanism is nothing but 1 divided by this factor. Now, my 100 is into this divided by sum. So that's how my 100 gets distributed. What is this weighting? Inverse weighting.
Yes, inverse weighting.
There is not much merit, but nobody stops from creating your own factors or weightages. As I said, there is no merit, but nobody stops you from experimenting. what that is? Square. My factor becomes square of that. I think I've done it correct. Right? So this is my square weight. I got scared because of the 3.33 or whatever, but that's correct only. So if I do square weighting, how much D gets? How much D gets?
53%.
53 rupees. A gets rupees.
3% only.
I also can do square root, which is square root of like this. So this is square root weighting. And if my returns are some random returns, right? 8%, 12%, minus 5%, 20%. My portfolio returns would be in equal weighting. It is this into this divided by 100. So sum. So I get 8.75% returns in equal weight, right?
Yeah.
You can calculate for different weights what the portfolio returns are. Now we will experiment here. I have just taken the same stuff. If it is equal, put 0.1, that is 10%. If it is inverse, put 1 divided by that factor. If it is square, make it square. If it is root, make it square root. Else, it is the straight, which means the same factor weight. So you fiddle 5 combinations in this, and 5 combinations, and 5, and 5. And the final number, what I'm taking is a multiplication of those numbers, those factors. And all this 10 sum, and this into 100 divided by sum is my weight, right? That's what my portfolio weight for that particular stock. If I do in whatever I write, a multiplied final factor, I get this particular weightage for this year. All this is put together, it will become 1. It should be 100% or 1. And these are my returns. This into the stock returns, which is 70%. So at a portfolio level, I lost 2.2%. The same thing. So just sum of each years and CAGR, and I think I haven't calculated that all for those factors or whatever. those metrics you can calculate because you know the way now. And you can experiment here. So if I put equal everywhere, I should get 600, that number, right? So 641 or whatever is that number. Now I can change to whatever I want. Is it becoming better or is it becoming worse? So you fiddle and you come up with whatever suits you. And if you believe in this whole story, you invest. Don't ask any questions. Nobody is going to come to your rescue if you lose. Similarly, you are not going to give me a portion of the profits, right? So that's what it is. There's no gimmickry that is happening, right? Yes or no?
Yeah.
Now, what I would say is these factors are goes through their own ups and down cycle. So instead of picking one model, you pick two factors. Like this is R2. I think we picked up low beta and we are fiddling with the weights. Now you pick up other factor also, whatever is second best. So don't invest all in one factor because you can go wrong. So instead of one, you pick two. Now in fiddling, so I'll just put in root. I'm just blindly putting, right? And this is square. What is happening is forget about the returns. At 1 year, what is the maximum weight? This is nothing but max of this. Some year you have put 31% in one stock. You can find which stock, which year is that. That is the maximum weight. This particular formula is given. So pay attention. You don't want to be more than 50% in one stock for 1 year. Or if you are risk oriented, who cares? Even if it says 100% in TCS or BPCL or Suzlon, because your model is telling so, you put. It's up to you, right? But you can pay attention here and have your own rule, right? What is that maximum allocation that you would allocate for one particular stock? Right. Any questions so far?
So, Kora, like you said, invest in maybe two factors. Are you talking about clubbing both of them and making one model, or is it like, hey, have two portfolios?
Now this is one portfolio. Like I'm not bothered whether you like this in-win root square model or whatever. This is one portfolio. So for this year, this is the allocation of that model. So this is the final weights, I think. Yeah. Whatever model is that, bottom beta into each factor weightage. So this is what you got. So your 1 lakh rupees. Sorry, 1 lakh, right? 100,000, 10,000 lakh into this. So your 1 lakh gets distributed like this. In whatever is that, you have to go back and rework the entire stuff, right? How many stocks? Round of this amount divided by, I think this is the price on December, into 0. So I get 3 stocks of Cipla. Oh, this is unfortunate. So you have to, your 1 lakh is not sufficient. So you have to at least get 1 stock of this. Maybe you have to jack it up to 2 lakhs or some other number, but I'm just taking 2 lakhs. So then you get 1 stock of Nestle. So that's your portfolio allocation for this year. This is one, and this is a fairly small amount, right? We are not talking crores and crores. This is just 2 lakhs. Now go back and do another model, get another weightage, and again invest in that. So there may be an overlap. Again, you might get 2 or 3 same stocks. Then again, you do that. Right?
Yes, interesting. Thanks, Kora.
Yes, very interesting indeed.
And you don't go, I'm not saying you won't go wrong. Even if you go wrong, it won't be a costly mistake. Right? These stocks they can go up, they can go down, but definitely they're not going to go to 0, right?
What happens if they are out of the index?
Sorry?
If any of the stocks are taken out of the index during the year?
No, you are not audible. Hello?
Yeah, in case the stock is out of the index during the year.
Sorry, you have to be a little loud. I can't hear. Even others also can agree with me.
You can maybe type in the chat. Your voice is not very clear.
Yeah, you can do that as well. Yeah.
He's saying, what if the stock moves out of the index?
You are revisiting only at the end of next year, right? You don't care.
Yeah, so irrespective of whether it is indexed or not, you will
continue. Your pain is only for 1 year.
Okay, you will remain invested. Okay.
Why do you bother? Just like 200 days, right? Year is 250 days. By the blink of eye, it will be over. So don't bother too much. If you really bother, then whatever is that date, you take out that amount, you put it in liquid Vs or fixed deposit or gold, or go back and put that money in Nifty. And again, you are not answerable to anybody. Whereas this guy is answerable to every unit holder. If Access Nifty 50 holdings differ from Nifty 50 index, I can ask that guy, why are you doing that? Right? In this model, nobody is going to ask you because it's a proprietary to you.
Yeah, makes sense.
All right, so what we'll do is we'll take a half-an-hour lunch break and we will come back at 1:30 or around 1:30, 1:40. That's the maximum time I can wait. And I will start whether you come back or not after 1:30, right? What I'm also going to do is I'm not going to stop this meeting because morning we have seen a pretty goof up. So I'll keep the meeting as it is, and I will stop the recording and I will mute myself. And